Good evening, traders and investors. Will back here with another one, coming to you with a Tuesday market recap. Hope everybody had a very good day of trading today. And in today's markets, guys, well, a nice little bounce from the bulls after somewhat of an overreaction to the downside yesterday, resulting from the DeepSeek AI news over the course of the weekend. Now, of course, we did cover that news on the channel yesterday in yesterday night's video. However, I was also saying that it was probably a good opportunity to be buying the dip amidst the uncertainty and amidst the overblown reaction to the downside. And indeed, it was a very good proposition to be buying the dip. Most of all my trades that I placed yesterday, a lot of them I closed today for very healthy profits, and my Discord members did as well. And congratulations as well to you, too, if you were able to call the market's bluff. So a lot of the damage that happened yesterday, especially in big tech names and certain semiconductor names, was somewhat reversed today. However, we still have a few volatility catalysts on the horizon, arguably the biggest ones of the week. And of course, I'm talking about Jerome Powell tomorrow and the start to the big tech earnings season. So in today's video, guys, we're going to go over a few key things together. Number one, we're going to be going over two company earnings that I have prepared for you guys today. And that is going to be one that is on this list, StarBucks, and the other one, which is not on this list, is going to be Louis Vuitton, coming in with their earnings today, pretty much in or around the closing bell. Thereafter, guys, we're going to take a look at our technical analysis, see how we are shaping up after today's bounces on the SPY, the QQQ, and the minor sectors into Jerome Powell tomorrow. Very important day, of course. Then take a look at our technical analysis and some expected moves for earnings for the major big tech companies that will be reporting tomorrow, namely Tesla, Meta, and Microsoft. And I will let you know how I am planning to play those companies tomorrow after the close as well. And then lastly, take a very brief look into some closing trades made today and overall my plan and strategy for the next 2 weeks moving forward for earnings. So today should be a lot shorter of a video than yesterday, guys, because there's no major drama today to speak of, right? So I'll do this one in very quick and rapid fire format. Hopefully you guys appreciate that. So let's jump right into the action, shall we? So the SPY up about 0.86 today. The Q's up 1.448 as well. However, the broad market was not there today. It was largely a case of big tech recovery after yesterday's declines, investors pouring in and trying to scoop up some of those very juicy deals that occurred over the day yesterday. NVIDIA almost up 9%, reversing more than half of the damage that occurred to their stock price yesterday. However, because we did have a day in which yields were rising, well, unfortunately, you did get in a situation where the bottom half of the market, especially after today, they were doing some of the heavy lifting. You guys remember the heat map from yesterday, right? It was the inverse. All of this was red and the bottom half was green. Well, now the rotation has flipped, the bottom half of the market taking a little bit of a well-deserved breather and some more money flow back into big tech, benefiting from those discounts that we had yesterday morning and afternoon. Moving into the one-day relative, you'll see this even better, guys. Technology, communication services, and consumer cyclical were higher on the day, and everything else kind of taking a little bit of a retracement to the downside. No major red flags in terms of market breadth. It's obviously just been, oscillating between big tech and the rest of the market. But it's true, guys, that we have not seen many days over the last month where you see a full green heat map where everything is kind of firing on all cylinders. It's just been rotation in and out of certain sectors here and there, but that is fine and healthy for the market. But I'll remind you, when you really want to see the big gains and SPY gaining new levels to the all-time highs, you need to see at least a few weeks of back-to-back non-stop broad market rally, something we really have not seen since the month of November, so keep that in mind. Also, in terms of seasonality, we're wrapping up the month of January, which is known to be one of the more volatile months. February is a mixed bag as well. Some months positive, some months are negative, but towards the end of March, unilaterally, mostly across the board, when you look at any market in the last 30 years, other than recessionary markets, of course, usually from the end of March into early May, you do have a nice sustained bull rally. So we're going to be positioning for that in the next few weeks on the channel, and I'll keep you guys updated as usual with my positions. Moving into the fear and greed index, guys, well, you'll see that we're still at a fear read. Potentially, if Jerome Powell is nice to us tomorrow and big tech earnings come out and smash it, maybe this moves into a little bit of neutral. But obviously, if the flip side is true, Jerome Powell is quite hawkish with us, and big tech earnings are not substantially better than anticipated, well, we may just be continuously oscillating here between fear and neutral. But I think the conditions of extreme fear are somewhat largely behind us. A lot of momentum indicators indicating that we are still in some form of a fear environment. I think that's been clear just by the sheer size of the volatility of the moves that we've had over the month of December. They have been many and not that far between. Huge swings down and up both ways, really making this, if you're not paying attention and not looking at the rotation, making it a little bit challenging for investors and traders alike to navigate the landscape. That is what I'm here for, though, guys. So fear not, I will be with you this entire way throughout this duration. But overall, guys, a somewhat healthy picture. Now, before we get into more technical looks, guys, let's jump right into our earnings. And we're going to start it off with a very nice one, which is going to be Louis Vuitton, LVMUY. So this is a company that I bring up whenever they have earnings. If not, I don't really talk about it unless I'm looking at building some very nice positions. And I've been very clear on the channel, Louis Vuitton has been one of my favorite stocks over the course of the last quarter. I did believe that under 140 down to 120, the stock was significantly undervalued. And now for anybody that had bought that dip, we are now up a very nice amount. And they just had their earnings today, largely ending flat, somewhat flat after their earnings, had a tremendous rally into earnings. So kind of like SOFI, right? You have a massive rally into earnings of 21% in just a few short days. Unless the earnings are substantially more fantastic than a 20% 6-day rally, well, you might end up taking a little bit of a beating. And that's exactly what happened with Louis Vuitton today, only down 2.26. Let's have a look at some of the numbers, though. 0.48% beat on earnings, but a tiny, ever so tiny miss of $5 million on 44 billion. So you can argue that this is almost flat, but nice to see them recover a little bit. And I'll remind you what was plaguing the sector. The sector was being plagued by the same things that are plaguing a number of other consumer, either discretionary stocks out there or whatnot, is the sheer amount of pulled forward demand in 2022 and 2023. When interest rates were low, stimulus checks were hot, and everybody had a ton of money, there was a lot of pulled forward demand for luxury goods, not only luxury goods, but also iPhones, iPads, personal computers, televisions, everything you can think of possibly buying. And usually when you buy one of these $3,000-$4,000 handbags, it's not as if, well, unless you're some people, right? It's not as if you need a new one every single year. You probably spent the money here, and then you're happy with it for about 5, 6, 7, 8 years plus potentially. So a lot of pulled forward demand, and now they've been in a little bit of a cyclical downturn through 2024 as one of their hottest markets, usually hottest markets, China, was somewhat lagging behind in terms of the recent years of historical trajectories, right? Now we were going to ascertain, is 2025 the turnaround year for the return of demand for luxury goods? Well, let's have a look. World's largest luxury group, LVMH, posts better than feared full-year sales. And that's what they mean, feared, because they weren't sure whether or not the cyclical bottom was in. Let's get into the article, shall we? So they reported better than expected full-year sales and the strongest sign yet of a potential turnaround in the high-end sector. The full-year figure equates to organic growth of 1% versus the previous year. The expectation, however, was slightly negative. So this is actually a positive bump. The growth was led by consumers in Europe, the US, and Japan, while the group cited continued weakness in the wider Asia region, namely speaking about the Chinese market. In 2024, amid an uncertain environment, LVMH showed strong resilience. This is true. This capacity to weather the storm in highly turbulent times, already illustrated on many occasions throughout our group's history, is yet another testament to the strength and relevance of our strategy. I'll remind you guys, Louis Vuitton is a conglomerate of over 75 different luxury brands. Watches, jewelry, makeup, clothing, accessories, leather and fashion goods, of course, duty-free stores. I bet you didn't know they had that. High-end, physical location, high-end physical grocery stores as well. They have a chain across Europe pretty much. They have absolutely everything you can ever think of, guys. And as a result, they are a conglomerate. That is the competitive advantage of Louis Vuitton. It is not just one of many luxury brands. It is the largest luxury brand conglomerate on the entire planet. Let's move on further, shall we? So Bernard Arnault, the CEO and majority owner of the company, noted a substantial decline in the company's cognac and spirit sales, but said he expects a recovery within 2 years as a new team takes over. He added that, despite ongoing geopolitical and macroeconomic uncertainties, the group's outlook for 2025 was starting well. So let's move into that, guys. Very brief article, but I want to take you into the shareholder presentation because there's a few key things to note here across Louis Vuitton's business. Now, at a first glance, I always want to mention that they always give the nicest pictures, in my opinion, for their presentations. I mean, you can't really blame them, right? They're a fashion company, so they kind of have to show up, keep up appearances, in other words. But moving on from the very nice pictures that Louis Vuitton shows us, such as these, we have to move into what exactly is happening with their business. Take a look at wines and spirits. So they divide their business into 5 different distinct categories. Wine and champagnes down 3% year over year. Cognac and spirits down 14%. We'll get into the rest, guys, but I just want to show you where the pain points of the business are. Here they give some, selective retailing is usually one that outperforms Sephora. I don't think you guys knew that Louis Vuitton owns Sephora. This is the largest cosmetics brand on the entire planet when you measure by sheer amount of stores and sheer amount of pure sales volume. Way bigger than Ulta Beauty, way bigger than Elf Beauty, way bigger than L'Oreal, way bigger than everybody combined in terms of physical locations and the pure amount of foot traffic that goes to their stores. Now, moving on into the actual analysis portion of it, I want you guys to take a look at this. Revenue up about 1% year over year. Profit from recurring operations, that was actually down by 14%. So the operating margin getting hit a little bit as they had to deal with the same amount of costs, because Louis Vuitton doesn't usually cut costs for luxury brands. Slightly elevated costs and an elevated dollar, which hurt their currency transactions as well, which resulted in a little bit of a hit in the operating margins, but nothing bad per se. However, they delivered a substantial amount of money to the free cash flow portion of the business, guys. 10.5 billion euros in free cash flow. That is up 29%. The highlight, in my opinion, of the entire earnings presentation. So if we take a look at their revenue mix, then we'll break it down. You can see that a lot of it comes from the US, a lot of it from Europe, a lot of it from Asia, excluding Japan, and some from Japan. But most of this business, guys, even though it includes all of South Asia, it is namely China to begin with. So if you take a look at the growth for all markets, you'll see the US here is planted at 2%. Now, not as bad as the midpoint of the year, but still a little bit low. Japan was the bright point for the fourth quarter right there. Asia, excluding Japan, coming off the lows, but still weak. And Europe also in line with the last 4 quarters, so nothing fancy to see there. But here you go. Here's the business breakdown, guys. Wines and spirits, 24 versus 23. Down 11% on wines and spirits, down 3% fashion and goods, 2% up perfumes and cosmetics, 3% down watches and jewelry, and 2% in selective retailing. Sephora, the duty-free stores, I don't know if you knew that, but Louis Vuitton owns almost every single duty-free store whenever you go into an airport anywhere across the world. It is called the DFS brand. Now, moving on further, guys, you can see that overall reported growth was at a slight decline, but organic revenue growth, meaning growth without acquisitions of new business lines, is at positive 1%. So overall, the business is seeing a bottoming out of cyclicality, and we're starting to round the corner a little bit when you look at what's happening in their various distinct markets. Japan is an outlier, but you can see the United States is not dropping anymore. Asia is arguably not dropping anymore, and Europe as well is not dropping anymore. So we're starting to see a rounding of the cyclical portion of the business. And that's what I've been looking for in Louis Vuitton as a whole, improving trends in retail, Q4 versus Q3. This is what we want to see. Total group 1%. But look, wine and spirits, although it's bad, it's not getting worse. Fashion and leather goods, off the bottoms. Perfumes and cosmetics, rounding the corner. Watches and jewelry, a little bit of, a little bit of positive and negative data overlap here, but overall not getting worse, and selective retailing holding on to its own. So overall, guys, we're not seeing a deterioration in the trends of a business. You are seeing a marginal improvement in the trends of a business. So we are rounding the bottom, at least for now. So that is the analysis for Louis Vuitton, guys. That's what I wanted to see for the business. Now, in terms of valuation, well, you'll see right here, they're growing revenue at 6.5% per year, EPS growth of 10% per year. But as I said, due to the somewhat cyclical nature of the business, which ebbs and flows with the amount of money in circulation, 2021, 2022, 23 were outliers. Let's be honest, guys. When does the government ever give trillions of dollars in stimulus money? Not that often. But if you were to smooth out this chart, it is a very smooth EPS progression chart. And in terms of revenue, it is usually a very smooth progression in revenue up and to the right-hand side. And the benefit of this business, of course, also has to be the record amounts of free cash flow. The free cash flow yield right now is absolutely insane. You're talking about a business bringing in, let's call it, for all intents and purposes, about $80 billion of revenue per year, 90 billion of revenue. Look how much free cash flow they bring in. 12.54 billion was 2023. And the year that just ended, although it's a little bit under this number at 10.5 billion euros, that's roughly about $12 billion. very healthy numbers overall here, guys. So overall, guys, the valuation of the business is quite decent in my opinion. At 155, you're sitting at a 25.9 forward PE, which is slightly above the historical average of 22, but nothing crazy, still within reason. And when we look at the PEG ratio, well, it's only growing at 10% per year. So the PEG is not the best. It will be a 2.59. Focus on the value metrics of this company, and the free cash flow yield, guys, 12%. That is absolutely nuts. The last time I did this one, it was around 5, and I did a mistake in it, guys. It was around 5 or even 4. I took the first half instead of including the full year, and I didn't convert it into dollars instead of euros. So that was my bad on that one. Did a little bit too fast at night, my apologies. But now the true free cash flow yield with 2024 is 12%. That is absolutely insane. Usually you're used to seeing businesses around 3 to 5%. Anything over that is very good. So at double the average of now at 12% is absolutely fantastic for the business. I would not be opposed, even though I have been adding a ton of shares to my long-term portfolio down here. I would not be opposed if we do revisit this level to buy even more. 140 down to 120. Weekly uptrend is now recaptured. Looking for the higher low for possible further trend continuation. And eventually, through 2025, I do have confidence in Louis Vuitton to eventually also recapture the monthly uptrend and just start resuming business as usual. Because when you look at the chart on a longer term time horizon, guys, it does look very good, especially since they really started becoming the conglomerate that they are today. And they really started acquiring and assimilating other businesses in a very aggressive fashion right around there. And you can see what it did for the share price. So I think if they continue with this business model, they should be able to perform very well throughout this consumer progressive recovery. We're not going to snap our fingers and stimulate demand. We see that with other brands, such as the one we're about to see, Starbucks, personal computer brands such as HP and Dell. They're still saying the consumer is tapering back on purchases. New home sales, new auto purchases as well. Those markets have been largely flat too. So the consumer is doing okay, but I wouldn't say they're back spending in full swing. So we will see that eventually, but not for right now. So Louis Vuitton remains somewhat of a recovery story. But if there's one recovery story that I do want to bet in the market, it is definitely with these guys because of the substantial moat that they command over the respective market. Moving into earnings number 2, we're going to be tackling Starbucks. Starbucks, guys, after the close, up a minor 0.68%. But I mean, this company, after being down 42%, now somehow is only down 20% from the all-time highs. I know it sounds like a lot, but it's really not that much in the context of where they just were a few months ago. Moving on further, guys, when Brian Niccol took over, of course. So Starbucks, where to start? I'm pretty sure you guys know what the problems of Starbucks has been. It's been an execution problem, right? Not converting enough clients to come into their stores, dwindling foot traffic, dwindling sales, baristas not being able to put out the orders fast enough because they're either understaffed or because the orders are just too complex and they take too much time to make. So there were some execution problems as well as their entry into China right into the pandemic. They opened a ton of stores, guys, over 5 figures worth of stores, talking like 10,000 stores plus. And unfortunately, that expansion plan came flat on its face with the onslaught of the pandemic. So Starbucks has been kind of trying to cling on to their former glory. And just a few short months ago, this gap right here is them bringing on, well, one of the GOATs of the CEO game, especially in terms of quick service restaurants, Brian Niccol, who helped Chipotle on their monster rally from almost nothingness to the company that they're known now 10 years later today. So this is a question of when is the recovery story from Starbucks actually going to manifest? Well, if you look at the after hours performance, you might think it's today, but this is a case of it was not as bad as expected. Kind of like the Louis Vuitton headline, better than feared. Starbucks is the exact same. The numbers objectively are actually bad. They're terrible, guys. Let's be honest. They're actually terrible, okay? But they were less terrible than Wall Street expected, so obviously the stock goes up. No, moving into the numbers, they were up 3.38% on EPS. They found a way to beat EPS through some cost-cutting endeavors and less promotions. And they also somehow beat on a very low guidance number of by about 0.88%, almost 1%. So I'll give credit where credit is due. Starbucks did have a very decent quarter. And the one thing that the company has been able to do very well is protect their free cash flow. So let me move into the article. We will not go through earnings slides presentations like this because we don't need it. The article did a great job of summing it up, and I also did a good job of summing up the problem. So we don't really need to go into, I'll let you guys know about the margins and stuff like that as we move through, but no real need to actually go in and analyze what the problem for Starbucks is. We know what the problem with Starbucks is. We've been talking about it for the last 3-4 quarters. It's an execution problem, right? So moving on, Starbucks earnings top estimates, but same-store sales decline for the 4th straight quarter. Before this started happening about a year ago, guys, Starbucks had never had year-over-year sales declines in 20 plus years. Let that sink in. Moving on further, same-store sales slid for the 4th consecutive quarter, but the company's quarterly earnings and revenue beat Wall Street's expectations. The coffee giant kicked off a turnaround plan last quarter in the hopes of reviving its US business, which has slumped over the past year. Here's what the CEO had to say himself. While we have room for improvement, we're making progress as planned and have confidence we're on the right track. Of course, he has to say that, guys, right? As the new, redevelopment plan of Starbucks starts. Now, Brian Nichols added that the company has seen a positive response to the early steps it has taken. Those tweaks have included removing extra charges for non-dairy milk options, focusing its marketing on its coffee, and slashing 30% of its food and beverage menu items by the end of fiscal 2025. Brian Nichols is extremely good at one thing, guys. He's extremely good at focusing on a company's competitive advantage and focusing on that alone. Focusing on the coffee. A lot of criticisms of Starbucks in the most recent years is that the menu has become far too complicated. There's just too many options. You can replace this with that and just too many options to where people slightly get confused. And it can be a turnoff for a recurring customer to get in there if they feel the order process is a bit too complex, right? So moving on further, I'll show you another few tweaks that he's been doing. Nothing major, but when you take a few tweaks here and there all across the business, it comes together to just put everything back together in a very orderly fashion. Let's move on, shall we? So extra charges for non-dairy milk options. They used to do that. Let's say you're lactose intolerant and you want soy milk or almond milk or whatever type of milk you want. They would charge you for that. Now they're doing charge-free for non-dairy milk items, which is a very positive step for Starbucks because you guys know it best, right? You put too many things in a Starbucks drink and your coffee cup's going to be this big, but they're going to charge you $20. That needs to stop. It's become a meme, and Brian Nichols understands the meme, and he's looking to address these situations. Starbucks reported fiscal first quarter net income attributable to the company of $780 million. Listen to this. $780 million is their net profit, down from $1 billion a year earlier. So a 20% dip in net profit, but the net sales are the same. This means that their profit margin, I'll save you the calculation, went from about 11% to closer to 8% in a year. So they've got crushed in the margins and the revenue has been flat. Starbucks same-store sales fell 4%. Fueled by a 6% decline in traffic to its stores. I told you the numbers are going to be bad, guys, and they're not good. Same-store sales down 4%, 6% decline in foot traffic. Wall Street was expecting a steeper drop of 5.5% in terms of same-store sales. That's why the stock is up, because they're only down 4 instead of 5.5 on same-store. Both its US and international locations outperformed expectations, but when they say outperformed, they mean they were just less negative than they thought. US same-store sales slid 4%. Traffic to its cafes fell 8%. This was the overall number for the entire brand. US specifically, 4% down traffic and 4% down sales, 8% down traffic. Under Nichols, who took the reins in September, the company has been trying to turn around its US business by getting back to Starbucks, getting back to basics, and returning its focus to coffee and the customer experience. There's been some criticisms that Starbucks is moving into too much of a fast chain coffee experience like a Dunkin' Donuts or a Tim Hortons, where you just walk in, grab your coffee, and leave. When I was going to college, you used to go to Starbucks for 2-3 hours to study. Now, I assume that some people still do that. The times have not changed that much. And I go into Starbucks every now and then, and I still do see people doing that. But there's been a dissociation from that experience to what we have today. And Brian Nichols is seeking to understand why and looking to get back to that, have people spend more time in the stores. It builds customer loyalty over time. Moving on further here, guys. Starbucks has also been cutting back on deals, so its discounted transactions fell 40% during the quarter. There's the reason why the free cash flow and the margins are not falling that much, because they removed all the promotions. There's only 2 ways to turn a business back around, guys. You can either do deep discounts and try to attract customers in your doors through putting cutthroat prices that people have never seen. However, this is a marketing principle. You cannot do too much, or people will think there's something wrong with the brand, right? If you're always used to seeing Louis Vuitton handbags at $3,000 a pop, and then all of a sudden you see Louis Vuitton is never known for discounts, and all of a sudden you start seeing 50% deals on all Louis Vuitton items, but not just for one day, not just for 1 week, not just for Christmas, for 6 months, for 12 months, you may start to question whether or not it's such a high quality product. Apple is known for this as well. You rarely ever see any discounts on Apple products, very rarely, other than Boxing Day, Black Friday, stuff like that. Imagine if Apple were to do, virtually every single month, they were to do 30, 40, 50% promotions. You lose the luxury status of the brand while doing that. And Starbucks is known to be a brand that has more of a luxury appeal to it. You may not feel that way, but that's what they're going for. And that's what they're kind of known for in people's minds, right? So Brian Niccol has done away with those promotions because he doesn't want to impede on the status of the brand, right? Very important marketing concepts here, and he's well aware of them. Starbucks same-store sales in China, its second largest market, fell 6%, fueled by a 4% decline in average ticket. So the China expansion still doing poorly. Niccol said he made his first visit to stores in China last week. The company is exploring strategic partnerships to grow its business in the country. Curious to see what they're going to do about that, because that's the biggest pain point of the company right now, in my opinion. We are processing these learnings, and we will share more as we do, he told analysts. In October, the company suspended its forecast for 2025, citing the turnaround efforts. On Tuesday's call, they backed away from a target of $4 billion in supply chain cost savings by 2028. So they backed away from it because that was the previous CEO's plan. Now Brian Niccol is going to derive a new plan, so they stepped away from that. Moving on further, here's some more little tweaks that they've been doing. Planning fewer new locations and renovations in 2025 to free up capital to fuel its comeback, aka we want to protect our margins, we want to protect our free cash flow, we want to protect our dividends and make investors happy and stop dumping the stock. That's what that line means. Moving on further here, guys. Right? In the US alone, we will see the potential to double our store count. Well, this is onwards in the long term, right? We'll see the potential to double our store count in the long term while improving the overall health of the portfolio. We'll do this through a strong store renovation program, new store builds, and store closures. This is years and years to come, guys, of course, right? The company is also trying to improve its speed of service by scheduling more workers, removing bottlenecks behind its coffee counters, and making baristas' jobs easier. For example, Starbucks plans to prioritize installing its Siren equipment in its business location. The new equipment includes a custom ice dispenser, milk dispensing system, and faster blenders so baristas can make drinks more quickly. Very important, guys, right? Starbucks is also piloting a new algorithm to manage the order that baristas should make both mobile and in-store drinks. If successful, the algorithm could solve Starbucks' overcrowded pickup counters that cause frustration for both customers and baristas. So, an algorithm will tell the barista whether to make this iced latte first, or maybe they make this, fizzy drink, or whatever those types of drinks are with the syrup. You know what I'm talking about, like the flavored tonic water type of thing. Anyways, you know what I mean? So I don't take those drinks, but I know that these orders sometimes can be complex. So maybe if the algorithm is built into the cache and you have a tally of orders to do, maybe it tells you, okay, you can make this one while the coffee heats up for that one. You can go make this drink. Usually baristas know this, right? But keep in mind that if they're going to hire more employees, it's going to cause more commotion behind the counter. And at least you'll have one clear way of doing things if it's systematic, right? And the one thing, Brian Niccol is taking his experience from Chipotle. If one thing that Chipotle is very good at is doing it in a systematic approach at every single location, it is arguably the same, right? And even then, last year when they criticized Chipotle there was a journalist that said, I went to 25 different Chipotle locations and they gave me different sized bowls. Brian Niccol addressed that the very same month. He said, you know what? I told all my stores, give people more now. And now they don't have that problem anymore. So Brian Niccol is a big fan of normalizing, systematizing the experience across all different locations. No matter which Starbucks you enter, you should have the same experience. That's what he's going for here. In early March, the company is planning to lay off workers, white-collar workers, although Starbucks has not yet shared how many jobs will be affected, mostly office jobs, say at least. So, summary, Starbucks is moving forward. You can see, although you may think that the plans that they are doing, the steps that they're doing are small, this is true, but that's how it starts. Baby steps, right? Baby steps. He cannot overhaul the entire company when the guy's only been there for 3 months. But in his short 3-month tenure, he has already put forward more steps and more proactiveness in turning the business around than the former CEO had done in the prior 2 years as he was seeing his business go down the drain. So very good start. If I were a long-term shareholder in Starbucks, which I am not, it's not that I don't like the company. It's not that I don't like the brand. It's not that I don't like the fundamentals. It's just that there's only a few select retail companies that I'm exposed to in my long-term portfolio. Actually, there's only 2 of them. One of them is arguably Louis Vuitton, but for the consumption, like food, I only have Costco, to be quite honest with you, because I think their competitive advantage and their moat is far above that of a Chipotle, far above that of a Starbucks. Arguably, Costco and McDonald's is probably 1 and 2. You could put Coca-Cola in there as well. I prefer Costco because of the experience that it gives you as well. But then again, you can make an argument for all 3. But Starbucks is just not in that, the S tier. The S tier is Coca-Cola, McDonald's, Costco, and probably Walmart. That is like S tier, top tier. And then below that, you have a bunch of other names like Starbucks, like Nike, like Disney, like anything like consumer retail stuff. You know what I mean? So anyways, hopefully that makes sense. Now, anyways, moving on to the continuation of the analysis. To finalize the analysis, matter of fact, where does the company stand now that they're still down 20%? Are they a good deal? Well, arguably not so much. Revenue is up 6% per year. The EPS growth of 12% a year, that is very decent. At the current, this should be 2025. My bad, guys. I did change. These are all 25 numbers, but I just forgot to do them right there. So let me just do this real quick. They're all free. I just did them as a whole. So they're at $100, guys. They're trading at about a 32.3 forward PE. Relatively high, and at 2.69 PEG ratio as well for the company. Very high. So even though they appear to be down, they're not all that cheap. However, if we come back down into this location right here, 93 to about $88, the big area of support that the stock has seen over the last 2 years of trade, there could be some form of a swing trade opportunity targeting the highs. If you get deep into here, stop goes below there, the entry is here, and then you take a swing trade up to here. But as I said, long-term portfolio, it is just not making the mark for me. I prefer to be in companies that have far better moats, far better competitive advantages with less competition overall. And for me, guys, I mean, Costco, Walmart, Amazon, if you're talking about like grocery stores or places where people can buy things, and if it's just pure food, arguably McDonald's and Coca-Cola, for me, are the only 2 that I would put in my long-term portfolio. But of course, you guys are free to do what you want. That is just my opinion on Starbucks, but nice to see them at, embarking on their turnaround story in a very nice fashion. So all that being said, that is it for your earnings recaps. Now let's jump into the fun stuff, which is going to be the S&P and the Qs and all the rest, shall we? So moving into the SPY, guys. Well, the SPY is going to be a bit tough to drive because tomorrow we have the big event, which is going to be number 1, Jerome Powell. And of course, tomorrow after hours is going to be the earnings. So you can see here, I have the expected move on the Qs. I'll do the SPY right after this. Expected move is 1% for tomorrow. So it should be a big day either way. Into the SPY as well, it should be a relatively big day too. The expected move is about 0.64%. So it is an outsized day for tomorrow. However, if you ask me for my opinion on Jerome Powell, I think he realizes the damage that was done December 18th. He also realizes the situation that just happened with DeepSeek and big tech names overall. So he's probably not going to want to shake up the market too much. They've already given us the projections for 2025. They stated that inflation should be higher than they had previously anticipated, and that there should be fewer rate cuts than we had anticipated as well. So the damage is already done. The Fed is already hawkish in its outlook. What you do not want to see tomorrow is Jerome Powell saying that they are still worried about inflation and that it could move higher than their already heightened expectation targets. Same thing for interest rates. If he is too hawkish on the stance of rates and doesn't adopt the status that he's been for the last 2 years and saying data dependent, if he puts more emphasis on keeping rates higher for longer, or if there's any hint whatsoever at rate hikes, the market is going to absolutely get destroyed tomorrow, guys. However, I do not think that that is the case. That is the edge case scenario in my mind, 5% probability or less, but it is still on the table. 95% chance, guys, that he is going to say, listen, from the last meeting, we've got a somewhat favorable CPI report, a somewhat favorable PPI report as well, producer inflation, that has shown that inflation is not wildly running away. It is on a bumpy path back down to 2%, but they are being data dependent. If he just comes out and says that, the markets should be fine tomorrow, guys. But on the flip side, if you want it to be very bullish tomorrow, you want him to possibly revise these to the downside. Say, listen, we put a very high target in there because That is the peak of what we're expecting, but we may not be expecting all the way up to there. Maybe that was a little bit too much. If he says something like that, he's not going to say it like that. You're going to have to read between the lines, right? But if that is the tone of how he is speaking, I think we're going to have a pretty good afternoon tomorrow leading into big tech earnings as well. So that is my stance on Jerome Powell and some of the expectations. That being said, we can look at a few price action levels that'll be key to take a look at, guys. I mean, when you look at the SPY, right? Daily downtrend was clear as day. Nice daily engulfing move. Now, hitting the daily higher lows, going for the trend change. If Powell is bad tomorrow, or if big tech earnings are bad tomorrow, we are going to roll over below the lows, and you'll be heading into a new daily downtrend, and you will be heading in to weekly consolidation, anything above 575, looking for a weekly higher low for possible further trend continuation. After that, your next level of support comes down here where we've been bouncing out of since December, which is starting at about 585. However, if it is good with Powell tomorrow and big tech earnings are good, then Thursday morning, you may just casually see a daily uptrend break of the all-time highs and a weekly push towards new all-time highs as well, with a brand new established weekly uptrend. So that is in the cards for tomorrow, guys. Either way, it's going to be a big day, and either way, I am ready. I have my longs, but I also have a ton of buying power. If we get rejected and come down here, I will be buying more. Just keep your eyes peeled. Very tough for me to tell you what this chart is going to do because we just have too many catalysts tomorrow. Powell and all of these guys as well, right? So keep that in mind. Moving on to the Qs, 1.5% to the upside. It was a sweeping daily downtrend. Same thing, engulfing move. Get the daily higher lows right into support down here, 515 to 510, and now breaking up a little bit higher from that, looking to expand on the daily uptrend. Same concept. If Powell is bad, big tech earnings are bad, expect the daily downtrend flush and expect to maybe revisit some of the weekly lows around the 26 EMA, 500 down to about 495. However, if it's a good day overall, you can expect some continuation into the previous highs of the early portion of the week, talking about 533 up to the all-time highs 538. That would be your daily uptrend confirmation and also the weekly uptrend confirmation as well. So looking for very big levels tomorrow. Either way, as I said, I have my longs if we go long, but I also have a metric ton of buying power if ever we break short. The kicker here, guys, is the futures chart. I do not always bring this up because it encompasses overnight trade, but look how well we've held this area, guys. This is since Powell. Look at all the times we've tested this area here on the NASDAQ. And yesterday and today as well, dipping into here, the bulls buying the dip every single time on the Qs. That is this location right here, 515 down to about 510. It has been pretty much the golden area where the bulls have played massive levels of defense, and I do expect that to possibly continue. Moving on to the XLF right now. XLF also not looking too bad today, down about 0.18, but in all reality, flat. Still looking for some sort of a daily higher low after this crazy rally to the upside. If you want to know when this rally is done, guys, watch the loss of the hourly uptrend into hourly downtrend and the significant loss of the 12 EMA. You should have your local top, and you will be heading into daily consolidation. At that point, anything above 47, looking for a daily higher low for further trend continuation. Why? Because it was a daily downtrend here and a massive engulfing move. So the bulls now have all the odds in their favor of resetting into the daily uptrend. But if we get a daily downtrend, is it the end of the world? No, because look how much space we have now on the weekly. Weekly downtrend, engulfing move. You would also be looking for a weekly higher low to eventually reset this weekly uptrend. The max pain, in my opinion, for a retrace on financials could be back down here, 49 to 48, looking good for a retest of the 12 EMA on the weekly. It would look something like this in the grand scheme of the markets, maybe for 2025. Moving into XLV right now. So financials, still one of the favorite trades for 2025, arguably into a rate cutting cycle and in an environment, as we've heard from the banks and American Express, where the consumer is healthy and not over leveraged. Moving into healthcare right now. Well, healthcare battling, guys, with the previous highs, equal highs and now getting rejected. But that's all good for the bulls because they have tons of space. Daily uptrend, looking for higher low, anything above 139, looking for that higher low for possible further trend continuation. So we will see where they come down into. If you want my best guess, probably down to the moving average confluence down here, 143, 142. Find a base of support, and then we'll see, can they push this one higher, or do we get rejected? If we get rejected into the daily downtrend, understand what the bulls are trying to do here. After 3, 4, 5 consecutive months of weekly downtrends, we now have one large engulfing move, tons of space. At this point, anything above 136, looking for a weekly higher low for possible trend expansion. And I just took a cheeky little position today on NVO. So took a little bit of position on NVO. I think this company, guys, is extremely, extremely cheap right now in terms of valuation alone. I would put fair value on NVO somewhere between 110 and 115, but it is definitely a lot cheaper than the valuation does support in that metric. They're going to have, for all intents and purposes, take a look at this, guys, some very gorgeous EPS expansion and very beautiful revenue expansion over the next few years as well. And they were just authorized today. This is the reason that I pulled the trigger. Ozempic is the only one to get the FDA approval for kidney and cardiovascular disease purposes, right? For treatments beyond diabetes, which is known for, and weight loss. They are the only one now approved by the FDA for essentially to try and address some things surrounding cardiovascular disease and also kidney disease. So when I saw that, I said, you know what, maybe time for me to bid NVO. They've been crushed as of lately because of supply chain issues. They're trading below the 200 weekly EMA as well. I found an opportunity there, so I took it. Try to play this one a couple times. One up here, I got stopped out. One over here, right before Powell, and then I closed it right here before the drop. I was very fortunate to close it here. So we got into the trade here before Powell. It wasn't really moving for about a month. After Powell, I chose to close it. Good thing I did. They got crushed. Now I am back in for maybe third time's a charm on NVO. So we'll see how that one goes. Moving on to SMH right now. SMH up about 1.97 after the recovery of the sector. However, it was not the whole sector. Take a look at this. NVIDIA, Broadcom, TSMC as well. They were up 5%. But look at the rest of the industry. Now do you guys understand why I only play those three companies for the most part and some ASML? Because they are the industry leaders, guys. They are the ones that are not really affected by the consumer cyclicality that's happening right now. I've been over why other companies such as Texas Instruments, Qualcomm, Micron, ON Semiconductor, I've been over why those names are constantly down for the last 4 or 5 months. It's because the recovery of the auto industry, industrial industry, and also consumer electronic industry, they're just not back, guys. People aren't buying smartphones, laptops, computers, cars at the same pace they were in 2021 and 2022. So we are still waiting for those companies to recover. So if you're going to play semiconductor companies now, you have to play the ones that still have ridiculous demand through at least the end of 2025 in relation to the infrastructure build for data centers. And those companies I can name on 4 fingers: NVIDIA, Broadcom, TSM, and ASML. Even Micron, guys. Micron has a lot of exposure to the consumer. So although I like Micron as well, and I think it should do well, AMD too. AMD has all their exposure to the consumer right now. They have not carved a niche yet in the data center narrative. They're starting to, but it's not an established portion of their business as of right now. We'll see. It's supposed to be in 2025, but we will see. That is why I always play the same 4 companies. Hopefully you guys understand now. And that is also seen in SMH. Some companies like NVIDIA is up 9% today, but the whole index is only up 2% because the whole index is not participating. That is why the whole index has been flat, but other companies such as NVIDIA have pushed all-time highs. TSM has pushed all-time highs, and Broadcom has pushed all-time highs as well. Not so much ASML, that's a different story, but those 3 companies have been doing most of the major lifting. Now, reacting nicely from support, 233 down to about 218. Not too bad there. They have a hell of a gap here to fill, though. We'll see if they can do it. The resistance line above is 248 up to 261. Case in point, we are still trapped in this range of consolidation between resistance and below support, so I will play this the exact same fashion. If we see declines, I'm writing short puts below the market on my favorite companies right now, which are TSM, NVIDIA, and Broadcom for the most part. So that is the analysis on semiconductors. Not a bad day of recovery, but a ton of work to do. First, you need the daily uptrend. Then you need to break through this resistance. And then eventually you will need to set a new weekly uptrend because we had it and now we lost it. So you need to start everything from scratch. Could take a little bit more time than people anticipate for the recovery of the sector. Moving into the Russell now, up about 0.11%. Not the worst for the Russell, guys. They're looking for the bull flag into a daily uptrend break. That will be a breakout of 232, which is the last line of defense for the bears. Previous resistance from 2021. That is what's kind of holding us back here from further expansion. If they're able to get it, beautiful, nice. You have a brand new weekly uptrend in motion. That'll be good. And the daily uptrend is reset at the same time as well. However, falter and break down from here. And unfortunately, it's another retest of resistance gone wrong. And we're most likely heading back to the support level, which is is 217 to 206. I would be a small buyer of small caps in this location, but this trade is still fairly complex with higher for longer interest rates in the mix. Moving into the Dow Jones now, Dow Jones as well, up about 0.31%. Not the worst day for the Dow Jones, but also not a crazy day of outperformance. That being said, the chart is looking very nice, guys. This is one single large expansion move to the upside. Other than yesterday, after which they recaptured it in an hour, I'm going to use this as an anomaly. We have not lost the hourly uptrend, really have not lost the 12 EMA in a big fashion. You will know the daily move is done when those two things happen. We'll keep an eye on it because we're getting a little bit daily overbought, but not quite. Really flirting with the all-time highs right now is the Dow Jones. If we do pull back, guys, any move lower looking for a higher low, anything above 41.9, higher low for possible further trend continuation. On the weekly as well, if you lose this trend into daily downtrend, is it that big of a deal? No. Weekly downtrend, huge engulfing move, looking for a weekly higher low for further trend continuation. We have tons of support below, guys. The 12 EMA is there, and this is the same 43.3 down about 43,000 bucks, where could be the last line of defense to then pull in the higher low and maybe go for the weekly trend continuation as we move into favorable seasonality here, end of February, early mid-March as well. This whole period, right, is when the markets usually smooth out and start moving a little bit higher. So that's it for our sector analysis, guys. Hopefully you enjoyed that. Yields we covered yesterday, we won't do them. Bitcoin as well, we covered yesterday with the whole of crypto. It has not moved since yesterday. So for the sake of saving time, I mean, you're looking at this nice little breakout retest type of trade for continuation, weekly retest and run. But we covered crypto a lot yesterday, so I'll save this one for tomorrow after Powell because it will most likely move in a big way. I am positioned for some Bitcoin swing trades longs, but fully cognizant that we can indeed retest these lows if ever big tech earnings or Powell are not favorable for the risk on trade environment as a whole. And moving on to big tech right now, Apple, another 3.65% to the upside. I explained this one yesterday, why Apple was not affected by DeepSeek, simply because Apple has not made great strides in AI at all. As a matter of fact, for their AI on their phones and tablets, they're using a ChatGPT plugin. So it's not even their tech to begin with, right? Moving on, they have not committed that much capital. They have a lot of capital on the sidelines that they're not using to build out data centers for AI purposes. So they were largely spared from yesterday's sell-off. That being said, tremendous recovery for Apple into their earnings. Looking very nice, guys. New daily uptrend has been set by the bulls, creating a ton of space off the lows. This has created enough for a 7% buffer for their earnings, which is going to be on the Thursday. We'll see how they react to the rest of big tech. But all in all, guys, Apple's chart is recovering in a very nice fashion. Never lost the lows, touch of the 50, reacting nicely from support, 225 to 220, which is this zone right there. And now just looking to possibly, I'm not saying they can get the full V shape. It is possible, but the more likely scenario is maybe a two-step recapture of the weekly uptrend. So we will keep that on watch. Apple is Apple. At the end of the day, they find a way to get it done, whether it's organic or buybacks, they still find a way to get it done. But the valuation up here is somewhat questionable. I am not taking a position on this company before earnings because I see what they're going to do, what they want to do, and their guidance for the flat revenue they've had over the last 2 years. Moving on to AMD now. AMD down about 0.73%. Of course, AMD is down when the rest of everything is up today in terms of this list, almost, but they are down. So AMD continuing to struggle with the same things that we've been talking about on the channel for the last 4 or 5 months, let's just say, right? Monthly is in a clear monthly downtrend, as anybody can see. Weekly is also in a clear weekly downtrend, as anybody can see too. And now we are just in the process of finding the ultimate bottom for AMD, and apparently it has not been found yet. So the support below us, 112 to 100. This, in my opinion, is the final destination of max pain for AMD. The valuation right now is already a no-brainer at a 1.07 peg. At 114, this is arguably closer to a 1 peg. And the expansion thesis for the company in 2025, I'll remind you, is the expansion into the data center landscape for better EPS, better gross margins, better free cash flow, and better revenue profiles overall. We are not saying they're going to take all of NVIDIA's business, not even close, but can they carve away a 5 to 10% market share? Absolutely, and that's the thesis that I'm betting on, and that's also the thesis for all the analyst price targets at the 170. The analysts are only forecasting a 5-10% market share. That being said, daily downtrend is clear as day. We'll see if they can hold this support, but we have to start everything from scratch, guys. Need an engulfing move, then need to set up the daily trend change. A bounce is nice, but without a confirmation of a daily uptrend, you cannot say, okay, the lows are set, and we're going for weekly possible look into the trend change as well. They have to start everything from scratch. That being said, I'm still a fan of bidding AMD through the intermediary of writing puts under the market now at this point in time, the mid 100s, 105, 106 wouldn't be opposed to there, but I probably will not be playing it much before next week, which is the week of earnings. I do not want to enter AMD shares here, get trapped in earnings. That's the final flush when I could have bought shares after earnings if I was just a little bit more patient. Moving on to AMD, or Amazon rather, Amazon up 1.16%, new all-time high for Amazon. They clipped past 240 today, guys. This company is absolutely nuts. They do not have earnings tomorrow, but they can be affected by Meta and Microsoft earnings in terms of cloud guidance, because we know Amazon is the cloud leader in terms of sheer infrastructure and size on the planet. So we'll see what happens with them. But look at this, guys. Daily uptrend now set, now in motion for the bulls. Any pullback at this point, looking for a higher low. Anything above 226, looking for the higher low for possible further trend continuation. Amazon is set up in a gorgeous fashion into these big tech earnings on the daily and also on the weekly timeframes as well. If we're holding any shares, which I am in the long-term portfolio, I see no reason to sell. If anything, Amazon should be having a fantastic year. The valuation is not that bad. The growth profile is good, and the focus on profitability, EPS growth, free cash flow growth, and net margin growth is going to be front and center for Amazon this year. And I think they're going to show some free cash flow numbers that nobody even thought was possible just a few short years ago with their focus on profitability. Moving on to Google right now. So Google bouncing 1.7%, almost erasing most of the damage that was done after the market opened yesterday, but not quite the full gap, right? Moving on further, Google is in a nice daily uptrend right now. Higher lows are set, but you can also argue we're kind of just trapped in this range. So yes, it is a technical daily uptrend, but we're not really breaking through anything, are we, right? So we'll see if they can get it done. If not, if they just fail, I guess we'll just devolve back into this range, the bottom end of which is 191 to about 187, the lows of here. Prior to that, it's just the previous all-time highs. Arguably the better area of support is all the way down here at 180, but I'm not too sure we're going to get that unless we get a big broad market sell-off. Google is looking nice. The weekly is also looking nice. Consolidation range at the top of the move gives the bulls a chance to accumulate and possibly break out to the top. They have earnings next week, so we will see how Google is affected by earnings tomorrow, but obviously it's a carry trade. If all the earnings tomorrow are negative, right? If the market responds bad to this, Google will go down. If the market responds good to this, Google will go higher. It's really just as simple as that. Pay special attention to Google, especially their advertising business and cloud. We're going to get that from Meta for advertising, how advertising landscape is for 2025. Cloud, you may want to pay attention to, yes, Meta, but more specifically for Microsoft tomorrow. Those will be the two insights we get into Google before Google's own earnings next week. Moving into Meta right now, 2.19%. So Meta, this is another case, guys. Like, you remember the Louis Vuitton chart? You remember the SOFI chart? Massive rally into earnings and then a sell-off even though they had good numbers. Don't be surprised if Meta is arguably the same. I think that Meta is going to crush their numbers for this quarter, and I think they're going to give fantastic guidance as well. But if the guidance comes in just in line, the stock may sell off. Why? Because listen, guys, it's up 15% in the past week and a half of trading. So they have something to prove, right? If even with this rally, the earnings are fantastic, we are definitely going above 700. It's already very close. If not, if it's underwhelming or on par, but Wall Street sends it down, as we've seen in the past, you can expect a retest of this location here, arguably between these two lines, right between 634 and about 616. Now, I'm not just drawing these any which way. There is a method to the madness, of course. It is pretty much all the tops and all the lows of this range of all-time highs here. You can see clear rejection patterns in this zone. So 633 down to 620 could be a retest area. The expected move on Meta is about 7% either direction. I'll pull it up right here just so you guys can see. The expected move on Meta down here is about 7%. So 7% higher, we're above 700, and 7% or 6 or 7% lower, we are literally coming right down into that zone of support. Any lower than that, there's even more support down here at 597 down to about 580. So I'm not worried about Meta at all. But in terms of playing it before earnings, it's a little bit too high for me right now, but maybe will I play some put credit spreads down here, like 580, 575, 2 times the expected move? Possibly that's something that I will do over the course of the day tomorrow, but loading up calls here before earnings, I don't know, guys. It's a risky proposition. They've already ran a lot. I'm not saying it's not going to work. I'm just saying the risk reward profile is not the best right now, but you do you. Moving on to Microsoft. Microsoft, look at this move on Microsoft. 2.91%, guys. Look at this fantastic recovery. All of the damage from yesterday completely recovered and even moving a little bit higher. Microsoft too, a little bit of a pre-earnings run up, and the daily uptrend is now almost arguably back. This is a wide, super wide range. Microsoft doesn't usually move in this much of a volatile fashion, but it has been very volatile the last 1 month of trade. They're trying to get the daily uptrend back, and that will be a break of right where we are right now. If you come up in the 450s tomorrow, it will be daily uptrend. The expected move on Microsoft for tomorrow, guys, is not going to be that large, but it is still, you know, a big tech play. So it can move about 4%. You can see the expected move almost 4% up or down. So 4% to the downside where we were just there. It's going to put us in support 433 to about 424. This whole previous resistance range, right? That's going to be support where we fall back into. And to the upside, a 4% beat. Well, we're heading right back, guys, to the all-time highs, 465 to 470. So is this going to be Microsoft's breakout moment? A little bit too soon to call it, but if tomorrow's earnings are good, that'll be a brand new weekly uptrend, something we have not had, guys, since the month of November, where we tried to do it, and then it came undone. Now we're going to try to do it again. If Microsoft fails and comes back down here, quite simply, I will once again buy the dip and play these with some short puts, as I've been doing almost all year and making a ton of money in the process. If you want to know how I'm playing Microsoft tomorrow, probably going to write some put options down here at about the 415 mark. 410. If I didn't have the money for Microsoft short puts, I'd probably go with maybe some, you know, put credit spreads down here below 400. You want to be quite risk averse with your put credit spreads because it's a binary outcome. You either win money or you lose money, right? There's no being assigned shares and then running the wheel. It's either win or lose. So for that purpose, if your put credit spreads, maybe 395, 390, be a little bit safe with that, you know, below this whole support zone for the end of the week. Moving on to Netflix right now. Netflix down about 0.01, but for all intents and purposes, flat for the last 5 days. Still doing the same thing, right? Clear as day. Daily downtrend, big earnings push, new daily engulfing move. We're looking for the daily higher low for a new daily uptrend change. Where could we come back down into? Well, where we just left off from. Previous resistance, current support, talking about roughly 930 down about 903. If we do retest that location, could be a very juicy breakout. Retest and run. I'm going to sit there for it and may do some call debit spreads because call debit spreads are a very cheap and efficient way of entering a long play without going for shares. They're like between a straight call option, which on Netflix is quite pricey, even if you're out of the money, and they're between a call and shares. Call debit spreads, they have a risk reward profile right in the middle. They're better than shares. They move faster than shares, but they do not move as fast as call options. So you might want to keep that in mind if ever Netflix comes back down there. But all in all, the chart's looking great. Moving on to NVIDIA right now. So NVIDIA up about 9% today, but coming into resistance right now. Unfortunately for NVIDIA, usually I only close them if a week closes below. I'll leave it for now in the rare event that NVIDIA can recapture this entire box in one single week. It would be crazy, but I'll leave it. These are weekly support levels and weekly resistance levels. So now, yes, we are temporarily facing on the shorter time frame some overhead resistance, 134 to 128. This is true. We'll see how they react to it. After obviously a big flush, daily downtrend, you are expecting a lower high, but depending on the size of the bounce, it'll let you know, are the bulls able to recapture this, or are they just going to roll over? Well, as of right now, the size of the bounce is actually quite adequate for one day, about a 38.2 bounce. If they can get up to 50, which is 132 in price, or maybe a 618, 136, that would be an ideal situation for NVIDIA to be able to reset into a daily uptrend. The one thing you guys want to see if you're NVIDIA bulls, you need to see them recapture this support zone. This week, like by Friday pretty much, you need to see them come back above 138, 139, come back above, use this as support again, and then rebuild a new daily uptrend. As of right now, though, it's looking quite decent. I was saying yesterday, guys, you got to take these, at least with one share next time if you see this, guys. I never give financial advice. I never tell you guys to buy trades. But the next time NVIDIA comes down to the 200-day EMA, okay, that it has not tested in 2 years since the AI rally started, it comes back to the 50 weekly EMA, which it has not tested once since the start. Can you guys just at least buy one share? Or just buy, you can buy fractional shares. Can you at least buy $10, right? At least buy $10. If you lose all your $10 on NVIDIA, I'll PayPal you $10 or something like that. I'm just kidding. You know, don't take that to the bank. But you guys get what I mean, right? At least try, make an attempt at some trades. If you're going to buy the lows today, set a stop loss below here if you want to, right? Or a stop loss below my level, 112. But at least make an attempt at an oversold trade because they do not come around that often as a whole, guys. you know, NVIDIA down 17% day, guys, it's only going to happen once, in my humble opinion, right? Unless we get an absolute recession in a bear market. But that's a very rare event. So these were for buying, and buying, I'm very happy that I did. Reacting nicely from our support, 115 roughly down to about 110. Came right into it, bounced from it, bounced from the 200, and now we're right back up here. Looking good, but we will see if the bulls can actually get the daily uptrend status back. If we move lower, then I will be buying the dip heavily, guys. Short puts around the 115 to 110, ideally closer to 100 if possible, but I see no problem playing the 115 to 100 level. I think it's a very attractive level for NVIDIA's valuation right now. Moving into Tesla, I was trying to keep this one under an hour, but it looks like I'm going to go over again. I guess for earnings, guys, I'm going to have to go back to my same strategy that I was doing when I started the channel, which is literally a 3-4 minute recap of earnings, only highlighting like 2 lines in the entire article, doing a summary here, and then just giving my opinion. 3-4 minutes, because I'm gonna have to cut the time on these videos down, because a lot of the analysis, to be quite frank with you, I do a lot more in-depth analysis in the Discord. It's not a pitch for the Discord, but eventually there's gonna have to be a notable difference between the two services, right? So that's why I'm trying to bring the length of the videos down on YouTube and give you guys detailed videos on a Monday and Friday, but then midway through the week, I gotta be a little bit more, I gotta pick up the pace, just to say the least, right? So Tesla down, Tesla up about 0.24. They have earnings tomorrow. It's going to be a big day for Tesla. One thing to say the least, right? So Tesla, if you take a look at the expected move here on Tesla, you'll see that the expected move is about 8%, 8-9%. It usually always is. For tomorrow, it's about 8% up or down. So 8% to the downside, if we start from here, 8% down would put us roughly about there. 363 back into our support range, 350 to 330. These guys from down there. But 8% to the upside puts us at arguably very close to establishing the next high of a daily uptrending phase. So we will see if Tesla is able to do that. Huge focus is going to be on free cash flow, margins as well, and overall revenue expansion, because we know revenue for Tesla has been flat for about almost a year of time at this point when looking over year comparison data. Now, I'm, as a Tesla shareholder, guys, for the long term, I fully agree that Tesla is not just a car company, it's a robotics company, it's an AI company. They're going to possibly have insurance, they have an energy storage business, they have a whole slew of different businesses that they can ramp. The robotaxi business, of course, as well. They can all ramp these businesses, guys, but the ramp of these businesses is 3, 4, 5, 6, 10 years down the line to hit fully optimization at scale, right? If you're looking at Optimus as a revenue driver for Tesla, Optimus is like 5 years away, guys. Let's be honest. In terms of commercial applications at scale, we're talking about 5 years. So you can start pricing these things in now if you're a very long-term shareholder, but for the numbers that they have now for the next 2 to 3 years, the fair value, in my opinion, is 250. It really can't be above 250. This is very lofty. This you're starting to price in forecast metrics from 2029, 2030, and that's a little bit too far away. I like to do what's within reason, 2-3 years of projections. Going out 5, 6, 7, 8 years, guys, you're starting to price in a lot of the future right now, which is fine if you're a long-term investor, but short-term, if they don't put out the car numbers, because as of right now, their main product, like it or not, is still cars. If they don't meet the car numbers, as they haven't a few quarters in the past, right? Well, the stock price may take a little bit of a dip. So, excuse me, that being said, keep an eye. If they break this level to the downside, 375, we are heading lower. That would be a weekly downtrend. Weekly downtrend means we are in for monthly consolidation with the formation of these candles. Unless Tesla has a crushing earnings and somehow ends the day way up, guys, I will remind you the end of the month of January is this week. If Tesla ends red, that'll be doji number 1, doji number 2 with a possible red body. That will look a lot like monthly consolidation, and we probably will be heading into the mid $300 range, which is not a bad thing. We'd be looking for a monthly higher low for possible further trend continuation, but maybe not just setting record new all-time highs just yet. That is if they miss earnings. Now, if they beat earnings, well, then obviously it will be possible weekly uptrend, just simply continuation, because that's what we're looking for. Daily uptrend continuation, because the bulls are still in control, and possibly not the end of this monthly move. Suffice to say, the entirety of this chart and the next arguably 2, 3, 4 weeks of price action is entirely dependent on earnings, because earnings is going to break very key levels in either direction. So myself personally, I am playing Tesla. I'm using TSLL. I'm playing short puts under the market, 20 down to about 16, all the way down here, 2 times the expected move, because this is TSLL. If the expected move on Tesla is 8, this one is a 2 times leverage ETF. This means the expected move on this one is 2 times Tesla, so it's 16. You want to be playing this one at least 16% away, if not more. I'm going to play it at 20 all the way down to 16. I would not mind. This was the equivalent of buying Tesla down here, 330, 320. So I do not, or rather closer to 330, 335 actually. I would not mind buying Tesla down there, but still, I'm playing this with a bit of margin of safety. And no, I am not loading up on call options before Tesla. I just don't like the risk to reward, guys. Sure, it can do this, but in my opinion, guys, it's already ran a lot, right? The time for calls was arguably not here. It was all the way back there or here into the next catalyst into the Trump administration, right? But now, yeah, it's a little bit topsy-turvy. Where's the reward? The reward is up here, but where's the risk? The risk is down here. It's like a 1-to-1 risk to reward. Not the best in my opinion. That's why I'm not doing calls, because the risk reward on paper is not that favorable unless you think the price target is all the way up here. Then you may have lopsided, but that's up to you. Moving on to Palantir now. Palantir up 6.35%, largely erasing yesterday's damage. Daily higher lows are set, looking for the daily uptrend shift into their earnings, which will be next Monday. Palantir is looking substantially amazing right now. Look at this. Have we found an inverse head and shoulders on Palantir? Quite possibly. Looking good, though. Closing above support. 78 down to about $75 is the support for Palantir. Best case scenario, establish a brand new all-time high before earnings, and then you would do one of two things. You mitigate the risk for a big earnings flush, because if you put in new all-time highs, maybe the worst that they can fall is back to support number 1 or support number 2, 72 to 70. But if you absolutely crush it, you will just make a moonshot towards 90 and eventually $100 potentially. So Palantir is looking very strong. Tough to position up here either way, right? Palantir, nice new weekly higher lows are set, and now possibly looking to smash the new all-time highs. Palantir is looking very strong, all things considered, even though the valuation right now is arguably, well, not arguably, objectively, it's terrible. Same thing as Tesla. To price in these numbers for Palantir, even with this growth, you'd have to go up to like 2030 or 2032. Palantir is going to have to absolutely surprise us to the upside in terms of this revenue growth. The forecast for this year is 30%. If they come in over 30%, like 40, 45, then you can make tweaks to the valuation and you can somewhat justify it if they can maintain a 40% run rate growth for the next 2, 3, 4 years, if there's really so much demand that they cannot handle it, right? So we'll see what happens with Palantir, but we'll do more projections on this on the Friday session. But as of right now, it's not looking too bad. And lastly, SOFI. SOFI up about 0.56%, not too bad at all. Looking for the breakout, or retest, and possibly run. It was a daily downtrend. Now you have the daily engulfing move. Looking for the daily higher low for trend continuation. Not looking too bad at all, guys. On the weekly, same concept. This was a bull flag, even though it's a weekly downtrend. What were they looking to do? The monthly told it all, right? Monthly, little bit of a retracement down here. Now possibly looking for the expansion, still holding 15, 14 levels of support. Not looking too bad for SOFI overall. Recovering a little bit of the damage that was done from earnings. I like their earnings. We covered them on the channel yesterday if you did not see them. Breakout, retest, and possibly run. So it could be an interesting proposition if we're looking for a gamble, a momentum play on SOFI. It's pretty much here, guys. Stop goes below the lows, $13.64, and the price target is $20. The risk reward on this one is actually favorable. You have roughly, let's call it $2 worth of risk, $2.40 worth of risk, and to the upside all the way to 20, right? It's like a just under a 2-to-1 trade. You have roughly $4 of upside for roughly $2 of downside. It is roughly a 2-to-1. That is a decent proposition for a trade, whether you're using shares. Call options is completely up to you, of course, but I do see a swing trade opportunity here to SOFI. I'm not saying this is a sure bet. I'm just saying that the trade setup is looking quite attractive, right? And I will be looking to write more short puts down here if we continue consolidating in this range. I'll be continuously writing short puts, $14.50, $14 at the lower end of the range. And that is everything that I had for you guys over the course of the day today. Moving forward, I'll only show the full portfolio rundown Monday and Friday videos if you want to see those. I will show you 2 trades, not the new trades I made today, but I'll show you the trades that I showed yesterday that we did close today, and they were quite nice. So you remember the NVIDIA put wheel, 105 strike puts at almost the open pretty much. We got $1.21 for them, 2.5 weeks of time on these contracts. We pulled forward half of that premium today. I didn't even close them at the best time. They actually ran even further. You could have closed these by the end of the day at about 45 cents, but that's not the point. There's 2.5 weeks of time left on these contracts. Does it make sense for me to hold the 63 cents for 2.5 weeks It does not. I made 50% in a day. I take that capital off the table, de-risk for Jerome Powell and big tech earnings, and then I replace that capital for something that has full premium for the full time to expiry. So we're just being capital efficient here. The other one that I did close was TSM as well. So TSM, you remember this one? We wrote this one at the low of the day in the morning yesterday almost, for $3.30. These were 1 month contracts, long dated short puts. Look, we closed them today for almost 50% profit. As a matter of fact, these two, right before going to the gym, I closed these, and then throughout the afternoon, they actually moved even higher. You were able to close these even for $1.50. So for a lot of my Discord members closed this later than me and made more money, which is the point. I give the alert, and if you guys see it a bit late, I always try to do these things and give you guys a good margin of safety. But a lot of people made some very decent money, not only with these trades, but other trades that I showed you guys yesterday. We're up very decently in the last 2 days, guys, so I'm very happy the way we bought the dip. Same concept for the NVIDIAs, guys. I wrote them for $3.30. There is 1 month of time on these contracts. They're 50% profitable in one single day. Does it make sense holding the rest of the contract for a full 4 weeks, going through Powell, going through big tech earnings and the risk involved? No, you may as well not round trip any gains. May as well take the profit off the table and go shopping for something else that has full premium. You can even do the math, right? How much of premium is left at the 170s if I'm closing them for $1.70? There's literally 1% left in this contract. 1% for 4 weeks. How much is that, guys? It is only 0.25% per week. My minimums are 0.5% per week. So that's how you know the math is just not working out to hold this trade further. Those are the two trades that I'll show you that I've closed. I did make a few more. Well, we are carrying some trades. All the trades from yesterday's video carrying pretty much tomorrow into Powell. For the earnings trades for tomorrow, I will be playing some of which I described in the video in the respective sections for Meta, Microsoft, and Tesla. But other than that, guys, we are pretty much chilling on a ton of buying power, and we will see what the market frees up for us in the next few days. That is it for me today, guys. Right? I'll try in the future. I'll run it by you guys. Ask me if, I can always do earnings videos separately, but I don't like breaking up the channel like that, because then for every single earnings, there would either be another earnings video where I covered 2-3 companies, or a separate video like Palantir earnings, 1 10-minute video, Tesla earnings, 1 separate video. And I'd be releasing like 4 videos a day, 3 for earnings separately, and then 1 of these market rundowns. So I want to do them in the same videos overall here, guys. However, just let me know. Should I, instead of doing a 8 to 10 minute recap, 8, 10 minutes, 11, 12 minutes sometimes, instead of doing the longer format ones, do you guys just want me to do a very quick summary? Because I got criticized in the past for not diving into the numbers on earnings enough, as if I didn't know how to read financial statements or something like that. So that's why I chose to do them a bit longer and provide you guys with more a context of where the company is, where they're moving forward, what problems they need to address. But if I see problems in their balance sheet, the cash flow statements, and the income statements as well, in terms of margin compression or loss of operating leverage, I'll let you guys know. But moving forward, to save on time and make these videos more efficient, I can do them in 3 to 5 minutes. That's how I started off the channel. So if you guys want a shorter version of these earnings recaps, let me know. If you like them the way they are, I'll keep them the same, but I'll try to be a little bit more efficient. Maybe I won't read so much of the article. Maybe I'll just highlight a few points and do more bullet points, focus more on the financials of the business, so we can do that as well. Let me know what you guys want, because this channel is entirely for you guys. I try to modify my style as much as I can to accommodate the most amount of people. So thank you guys for making the journey all that worthwhile for me. That's it for today's video. Consider dropping a like if you enjoyed this video. Consider subscribing to the channel if you're new. Thank you so much for the 5,000 subscribers, guys. Hit that over the course of the weekend. Now new milestones and bigger milestones approach us, but for now we can really be happy I can be happy rather of the work that has been put in on the channel, and I have to thank each and every one of you for pushing me this far to where we are today. And lastly, guys, if you have any questions, also feel free to reach out down below in the comments. And in the event you guys want all of these trades in real time, here are all the trades since the inception of the Discord. The green checkboxes are wins, and the red little dots are losses. So these are all the trades since the inception of the Discord. We also do private morning live streams from Monday to Friday for 2 hours every morning, where I trade live and answer all of your guys' questions in real time with chart analysis, with options chain analysis, and everything that goes with that. So if that's something that interests you, the link is down below to the description. You can also chat with me all throughout the day. The live streams are recorded. If you have any questions on your stocks or options, you ask me in the chat rooms. I'm very fast to answer all throughout the day. And we also, you also do private videos as well, high level strategies that I do not show on YouTube, psychology of trading videos, how to quit your job videos, how to respective account positioning strategy, whether your account is 10K, 25K, 50K, 100K, 250K. I pretty much outlay a plan and strategy for each account structure, and much more in terms of that. And also all the TradingView watch lists. You get all my watch lists included in the Discord as well. All the technical analysis, so the support, the resistance lines, the patterns that I draw on the charts, and all of these annotations. When you guys see me do all these valuations for hundreds of companies in my lists, they all come with the charts as well, all included in part of the Discord. So if any of that interests you, the link is down below in the description. Hopefully I see you in there soon. And if not, I guess I'll see you back on the channel, guys. So take care. That's it for me. Always a pleasure. I'll see you tomorrow after the bell. Big day tomorrow, so be careful. But if you want to take a little bit of risk on the table, do it. But be very careful, guys. Only with money that you are willing to lose while playing the casino that is the earnings and Jerome Powell landscape. So that's it for me. Take care. I'll see you tomorrow. Peace.